Hi, I'm James Dunn. Welcome to the Inside Network.
I'm going in depth with Joe Millward, founding partner of Epsilon Direct Lending. Welcome, Joe.
Hey, James.
Great pleasure to have you here.
Thanks for having me.
Joe, can you describe Epsilon Direct Lending and where it fits in a diversified portfolio?
Yeah, sure. So Epsilon Direct Lending is a private credit asset management firm focused on lending to medium-sized Australian companies. And the purpose of the lending is to support growth of that company, events such as acquisitions. And where we fit in a portfolio is typically within the fixed income allocation. Our product has very low correlation to equities, it has low volatility, and it's an income product. Lots of interest income is generated from the borrowers, and that's paid straight through to the investors.
When you say medium-sized companies, what are the parameters that define that category?
Yeah, so the most commonly used parameters are the earnings of a business and the revenue that it generates. The major banks set the benchmark in defining what the mid-market is in Australia, so we follow the major banks' definitions, and the definition we adopt for mid-market is companies that have turnover between $25 million and $500 million, and we lend to businesses with earnings or EBITDA of at least $5 million.
So why do companies borrow from Epsilon?
Well, they're borrowing for the purpose that I just described, which is to fund a growth event such as an acquisition. A private equity firm might be buying the business. One of the things that differentiates us from the major banks, who are by far the largest lender in the space, is that we can act a lot more quickly than the banks can. The Epsilon founders are the investment committee. When you're buying a business, James, you want certainty over financing. You want to be able to move quickly to secure the acquisition that you've worked towards.
Why have the banks pulled back from lending in the areas in which you operate?
I'm not sure they've deliberately pulled back, James. There's kind of a lot of broad commentary about the banks pulling back from lending in general, but the statistics actually suggest otherwise. I think they find it challenging to do well in this space, and that's because banks are trying to standardise products in order to lower the cost to serve customers and improve their cost-income ratio. And the capital charges that are afforded to this type of lending don't help things. And so they struggle to act with efficiency to provide companies with certainty when they come to make an acquisition. And that's what sets us apart, not necessarily that the banks are overtly pulling back from the space.
So if they're heading towards a standardised lending product, are you the other end of the spectrum where every deal is different?
Yeah, that's right. And that's what a true direct lender is. It's a business or a fund that structures the loans from scratch without an intermediary, such as a syndications desk from a major investment bank or a debt advisor telling you what the terms and conditions are. When you're making an acquisition and you've got a medium-sized company, which is usually quite broad and complex, the loan has to fit the purpose and has to fit the risks of the business. It has to be structured with the requisite flexibility without sacrificing risk protections.
How quickly can you put a transaction in place? If a lender comes to you with a request, how quickly can you turn it around?
Yeah, so it's not a speedy process. When we say with speed and certainty, that doesn't mean it's an overnight yes or no where you go onto a website and click a button. If a borrower comes to us and they've got all of the required information, and we need quite a lot of information to get to know and understand the business and the risks that it faces, the full diligence packages and so on and so forth. If that's in place, and normally the fastest we could get things done would be 4 to 6 weeks.
And on the other side of the business, the investment side, the fund that you've got open for investors, what level of returns has the strategy generated since inception, and what is your target level?
We held a first close on the fund on the 1st of June 2021, and we're through our initial ramp-up period. Our target total return for our fund is the swap rate, that's BBSW, which currently sits just a tick over 3%. It's a swap rate plus 6%. So we're currently delivering that target return to investors. We're really happy with how the fund has progressed.
In that context of lower interest rates, which has turned a little bit in 2022, but it's still quite a pressing need for investors to find the levels of income that are a little bit higher than say, traditional income products. Is that exactly where it fits as a kind of alternative to what have traditionally been considered income-generating assets?
Yeah, it's interesting. Many investors, allocators of capital, they position private credit in different ways, and that's their decision. We're not here to tell you where to put it in your portfolio. We typically find it sits somewhere between defensive alternatives and fixed income. Within the fixed income universe, traditionally it's bonds that occupy that space. Bonds come with duration risk, as many investors have found over the last year or two. Private credit are privately valued. They're not publicly listed instruments that experience the same price volatility as bonds do. Sometimes it fits in a bond portfolio because of the income and defensive nature. Sometimes it sits in defensive alternatives because there is illiquidity in private credit. When you make a loan for an acquisition, there's a long payback to pay back the debt for the loan. It's not a single year payback, and so the capital is typically locked up for 3 years or so. And so that illiquidity sometimes sees private credit placed into defensive alternative buckets.
So really it's not going to be something that suits an investor who wants the higher return but also wants the liquidity. There's that inevitable trade-off.
Yeah, there is. There's a trade-off there. We think that investors are compensated for illiquidity. When you look at the spread differential between listed secured debt at the kind of ratings that our fund attracts, which is around the BB, BBB range, there is a 2 to 3% premium that's afforded for that illiquidity risk. So we think it's a good diversifier in a portfolio where you've got a liquid bucket that you can use to fund events that you need to, and then you allocate some money towards the liquids where you want income.
And the floating characteristic of the rate being set with BBSW as the basis, that's got to be attractive in a rising interest rate environment?
Certainly, yeah. We've seen a lot of inquiry on that basis. We set the interest rate every 90 days, and so we do really closely track interest rate markets. There's not the lag effect that you see when funds track the RBA rate. This is the bank bill swap rate, and it's short-term in nature, and so all of that benefit is passed straight through to investors. That acts as quite a nice inflation hedge we're finding in this kind of environment.
So what, if anything, should investors be wary of in terms of allocating to this kind of sector at the current time?
Private credit isn't like the equities market, where the more money that's pumped into equities, the more the prices go up. The more money you allocate to private credit as a discrete asset class, the more dollars there are to try and find a loan, which puts pressure on returns and/or terms and conditions that the lenders are providing to the underlying borrowers. And so what you have to be really careful of is that you're not supplying capital to overfunded or oversupplied segments of private credit. And that's particularly important right now as we're heading into economic headwinds, both domestically and probably more so offshore. Default rates on loans tend to pick up around this time. So what you have to be sure of is that the underlying portfolio is of a high quality, that you're not allocating to private credit funds that have very high LVRs, high leverage levels and low servicing as interest rates increase.
And on that note, there's quite a bit of activity in the private credit sector on the, as you just alluded to, property-based lending. But this business-based lending gives another diversifier within what's seen as a diversifying part of a portfolio.
Yeah, that's right. Yeah, so the private credit market in Australia was largely led by the establishment of real estate lenders that played just outside of the risk appetite of the major banks and have grown and done very well. And we're all for real estate private credit. We think it's an important part of a private credit, fixed income, defensive alternatives allocation. We think where Epsilon really does well, especially in this kind of environment, is its focus on non-cyclical industries. It's been a very long cycle, but real estate is a cyclical industry. And banks and some other credit funds tend to focus on cyclical industries such as real estate, hospitality, non-bank lending. Epsilon doesn't focus on any of that at all. It solely focuses on non-cyclicals. So our portfolio is comprised of businesses exposed to education, healthcare, telecommunications. And so if you're allocating to private credit because you really value the low volatility that it affords, then ensuring that you've got a good allocation to non-cyclical industries is probably a good thing.
Thanks, Joe Millward, Epsilon Direct Lending founding partner, for a really excellent summary of the opportunity in private credit on the business lending side.
Thanks for having me, James.